Good morning, ladies and gentlemen. Thank you for connecting to National Development Bank PLC's investor webinar to discuss half year 2021 financial results. We have with us today Director and Group Chief Executive Officer of National Development Bank PLC, Mr. Dimantha Seneviratne, who will take you through the presentation, to be followed by a question and answer session. We would like to inform you that this session is being recorded for a playback video to be uploaded to the bank's website later on. On those notes, let me now hand over to Mr. Dimantha Seneviratne to take the presentation forward. Thank you very much.
Thank you very much, Kumudari. A warm welcome to all the investors, analysts who are on this call. This is our second investor webinar for the year, and this is to basically cover the first half results of NDB Bank and the group companies. So warm welcome to all of you, and good morning to everyone. With me, I have some of the leadership team members who are joining this call. So later on, they will, if there are questions and answers, they will certainly join. They are on the call. Sanjay Perra, who is the Senior Vice President, Retail Banking, Deepa Lakurategama, who is the Chief Operating Officer, Suendri Muthukumarana, who is the Chief Financial Officer, Niran Mahawatha, Vice President Treasury, Indika Ranavira, Vice President SME Banking, Ishani Palyagura, Vice President Project Finance, KB Vinoj, Vice President Corporate Banking, Zian Hamid, Vice President Retail and Card Products, and Damita Silva, Assistant Vice President Digital Financials, and also Shankar Abhivadana, Assistant Vice President Corporate Planning and Strategy. So they are joining with me. So if there's any questions, they will also join me to answer. So our presentation is into basically 6 parts: corporate profile, the operating environment, financial performance, at the strategic focus areas, and also we talk about the way forward. Ended up with the question and answer session. So corporate profile, as you all know, this is NDB is nothing new to all of you. But key highlights are just to show that as a vision, we want to be a driving force for the financially empowered Sri Lanka. And 40 years in operating, operating in Sri Lanka. We have more than 3,100 staff in the NDB, and with the group staff, about 3,200 staff. And recently, last week, we were affirmed the A+ stable outlook credit rating from Fitch. We have 113 branches, 150 plus cash recycling machines and ATMs, and quite a well accepted NDB NEOS platform catering to many customers. And we are the only group company with the NDB subsidiaries in investment banking, wealth management, stockbroking, and all, where we can provide holistic solution. And of course, the governance framework is quite strong. And with all our results that we have been awarded with all the global awarding bodies, the Banker, the Global Finance, the Asia Money, Euro Money, all those with several awards that you have seen in the past. So with that, we move on to the operating environment. The first half, the operating environment, as all of you are aware, quite a challenging environment coming out from COVID third wave. Still there, actually in a challenging environment. But what has happened is that with the basic strong platform that we are laid, while ensuring that the staff safety, their health requirement, everything, we have been providing services to our clients uninterrupted, and also ensuring that the portfolio quality is maintained. So despite all that, we have been providing the key support that is required as a key contributor for the economic growth. That's the bank's prime responsibility at the moment. So we have been providing that. Of course, the travel restrictions in April, May also didn't help that much. That affected the business momentum that picked up in the first quarter this year. And the economic growth rate, I think it's from a contraction of 1.8%, negative 1.8% in last year, we are looking at a growth of 4.3%. Now, these numbers have to be reviewed in the current context with the COVID fourth wave progressing, but still certain economic recovery is expected in coming months. The other one is the country's foreign reserve situation. Of course, the country managed to pay 1 billion bond payment that was made in last week of July. However, I think that is quite a challenge that is being currently handled by the Treasury and the Central Bank. In terms of new opportunities, we had seen quite a good progress on the export side. There's year-on-year growth on the export volumes. So that's something good that is happening, and also the IT industry. Tourism, of course, are basically at a standstill. However, these are the challenges any bank is faced. But we are doing our best to ensure that we maintain one is the bank's strength, bank's profitability, while also ensuring the customers are supported. So we have been doing that by providing moratoriums to the impacted customers and all proactively to ensure that ultimately it's a win-win situation, because we all believe in sustainable banking. When customers are in difficulties, we need to help them out. So that also, as part of our responsibility, we are doing that. So that's a basically very high level operating environment that we face with. But despite all these challenges, we continued our internal process improvements, our investment in digital side, core banking upgrade, all that going very smoothly despite all these challenges. So that is the positive side of that. The NDB never stopped. Even in the last year during the COVID time, we worked very hard behind the scene to ensure that our digital platforms are up to date and providing good solutions. So as a result, you would note later on, some of those are reflected in the cost income ratios and all. But all in all, I would say that the hard work that we are doing on the system upgrades, the operation side are continuing. And we'll be coming up with several new projects. I think one key element would be eKYC, onboarding customers without customers coming into the bank to a verification process on the face recognition, using the face recognition technology. Will be the first to introduce that. Recently, we also launched the CRIB integration, Credit Information Bureau integration with the NDB Neos app. All that are happening. So I think when the economy opens up, I think we are on a strong platform to actually support the growth and propel the growth at a much higher rate. So moving on to the performance overview, these are the first half's results in a summary. Year to date, the total assets grew by 6% to reach 664. Loans grew by 10% in a challenging environment. We crossed 487 billion, and deposits grew by 5% to cross 515 billion. Profit after tax, I think one of the highest so far based on the results that have been released. We recorded 3.9 billion rupees, which is a 32% growth. Profit before tax of 21% growth, 6.1 billion. And more importantly, the net interest income, 17% growth, despite the reduction in the interest rates, or 10.3 billion NII. We have been, despite getting in new capital ratios improved. Even with that, the ROE has clocked 13.8%, one of the highest return on equity. This was 13.13 last year. pre-tax ROA of 1.68, again an improvement from last year 1.59. Net interest margin, again it has improved despite the lower rates to 3.23 from 3.0 last year. And cost income ratio, again first half is quite good. I think that's the best in the industry right now, 33.3% compared to 37% last year. So all in all, in summary, financially, I think we are performing quite well, and we hope that we should be able to continue the same trend, I think much more better once the COVID situation improves. Let's move on to the next slide, please. Yeah. So this is the income statement analysis on the fund-based income side. Interest income, we ended up at 25 billion and interest expense of 15 billion. So net interest income of 10.3 billion compared to last year's net interest income of 8.8 billion. So all in all, 1.5 billion increase for the 6 months, which is about 17% year-on-year growth. But overall, the total interest income and total interest expense, overall there's been a reduction despite the asset book growing by about 17%. Despite that, mainly because of the interest rate drop. However, bank managed to, the net interest income, bank managed to get 17% growth. So that's one key highlight I want to share with you. Net interest income, NIM, net interest margin also improved to 3.23. And net NII is the majority contributor to the overall operating income. NII contributed 67% of the total income. Other good development is the CASA. I think I'm quite pleased to share that in the first half of all the deposit growth, 50% of that came from CASA, current and savings account, which is a very good development. One is the lower interest rates. However, more than that, we had seen a lot of granular CASA coming in thanks to our strategy that we implemented in transactional banking and also more trade-based solutions. So as a result, we had seen a lot of transactional related customers moving their operating accounts to us, which is a good sign. So that means a solid base of current and savings accounts are developed, both at retail, SME, and corporate level. So from all sides, we see that growth. So that is a key message. Year on year, 54% or 48 billion has come as CASA. And as a result, our CASA ratio has improved to 26% from 21% in 2020 June. So that's 5%, 500 basis point improvement from 21 to 26. So that's one good story that I want to share along with the NIM or the net interest income growth. And this is on the non-fund based income or the fee-based income. There again, it's a good story. Net fee and commission income, we had for the first half this year, 2.5 billion compared to 1.7 billion last year. So all in all, 48%, almost 50% growth on the fee side. Again, the strategy that a new strategic plan that we launched last year, 5-year strategy, that's working really well, especially on the transactional banking element and the more trade-based solutions. That has actually helped to get this fee-based income improved. Also, contribution coming from our digital solution side, all that has helped us, and more trade volumes, all that. Despite the trade restrictions, I mean, getting this fee-based income improved actually speaks itself. The strategy on the more transactional based volumes has worked in favor of us. Other non-fund based income, that's 2.4 billion compared to 2.3 billion last year. So it's a roughly 6% growth. So all in all, we had total non-fund based income growing by 24% year on year for the 6 months. to cross 5 billion from 4 billion last year. So 1 billion growth there, all in all. So as I mentioned, one key reasons are for this fund-based fee-based income are the loan book growth, so related fee income from that. Then on our card side also there's quite a good growth in the NDB credit card side. Then the trade volumes, trade business volumes, as I mentioned, and also the larger transactions that are being shifted to us. Most of the operating accounts moving here in line with the strategy that has also helped to improve the fee-based income. And also the other key area is the digital banking side. There again with NDB making quite a good headway, fee contribution coming from that. So all that has helped to have a very solid fee-based platform. Actually, that would help us in the long term in a low interest regime. In a low interest, the reality, actually the real income comes on the fee side. So that is something we have been working hard, and quite pleased to see that the results are coming in. Let's move on to the other slide, please. Yeah, so this is on the impairment side. As we all know, impairments naturally with the COVID situation and the economy coming from a negative growth rate, naturally the impairments would be high. We had a NPL ratio of 5.63% as at June 2020. It was 5.35, so slight increase to 5.63. This is in line with the industry NPL ratio. However, what we did internally was that to build up our provision book, impairments were actually increased substantially, almost by 1 billion year on year. So for the first half, we had impaired assets of 4.1 billion total impairment charges that hit to the P&L, which is 31% increase from last year first half. So I think one key element here is that yes, the credit quality, the concerns are there. So that is why we are proactively, conservatively improving our impairment. But despite that, you would have seen the overall profitability growing up. So that's a key area that I want to highlight here. So again, key reasons are provision charges increase is one is the growth, loan growth. So impairments are also for the stage 1 assets as well, based on the models, not only stage 3. So when the loan book goes, there is naturally an increase in the impairment charges. Then the collective and individual level provisions that we have made, given the elevated market risk, etc. And also we have taken the most recent changes in the economic factors, the GDP growth, the negative growth rate, all those have been taken into the model and when calculating the impairment charges. On the other side, in terms of asset quality monitoring side, we have strengthened our recovery teams, the proactive collection teams we have strengthened, and it's actually wherever we are proactive, you get the best results. So that's historically we have seen that. So that's where we are paying more attention in terms of collection, recovery, and also providing solution when we had to provide because the customers also naturally got affected. So that is continuously happening, and we will continue to strengthen this area to ensure that the portfolio quality is managed. Overall, currently the exposure under moratorium is around 17% of the loan book, which are the situation at the end of the year as well. So that is one way I consider it as a good development because compared end of the year, we had a third wave. We are still in that wave. But despite that, there was an improvement, 17%, dropped to around 15%. But again, with the June, July situation, especially the lockdown and all, it has gone up to 17, but still it's managed around 17%, which is, I would say, it's a good sign because most of these clients are servicing their interests. However, they have asked for the moratorium. So that's something that I want to share with you all in terms of the portfolio quality. Then moving on to the operating expenses management side, that's actually a very good story. As you can see from 2016 onwards, how NDB has been managing the cost income ratio from a high of 49% in 2016 and to gradually bring that down to 33.3%. I think this is a very good story for any case study where how the application of digital solutions, application of workflows, internal process improvement, sustainable cost savings, the application of Six Sigma processes, application of robotic process engineering, RPAs. We have about 14 RPAs right now assisting us. All that has helped us to improve on our cost income ratio, reducing it. For example, the 14 RPAs, the robots that we are working hand in hand, has managed to reduce the headcount by at least 100. I mean, that itself is a sustainable saving. And also that has helped in the staff who were handling that to move into more value added kind of roles rather than handling mundane tasks. So that's one good element. Another element is the success of the NDB Neos app. If I had to share the volume of Neos app transactions last year, whole of last year, we had 46.4 billion worth of transactions routed through NDB Neos app. Roughly, that's about 1.7 million transactions for the whole of last year. This year, for the first 6 months, we had 1.6 million transactions and total of 52 billion worth of transaction. So which means over the first 6 months, the whole of last year's transactions have been covered through Neos app. And as of the July end, this 52 billion has gone up to 61 billion. So now, if you apply that, if you had to process these transactions based on number of the time that you have to allocate, that itself is another additional about 150 staff. But without any additional headcount, we have managed that. So that's the beauty of digitalization, and having that investment made 3 years ago, having that vision to go on that, actually paving good results for the NDB, and we will be continue to grow on this platform, ensuring that our cost income ratios are very well managed going forward. Moving on to the next slide, this is on the taxation and overall profitability. So all in all, total tax, there's a 5% growth. This is mainly due to the reduction in the tax rate. Effective tax rate now is 36%. So this is compared to the effective regulatory tax rate of about 39 to 42%. 2020, it was around 49%. So overall, the tax rate reduction has helped the bank to manage our taxes. So despite a 5% increase, the total tax paid was 2.1 billion. VAT is 1.1 and income tax of 1 billion. So the profitability ratios, if I had to highlight them, profit before all taxes, growth of 21% to cross 6 billion 93 million. Profit before income tax, 22% growth. So it's 4.9 billion, so almost 5 billion compared to 4 billion last year. And profit after tax, 3.927 billion compared to 2.9, so 1 billion increase or 32% increase on that. And profit attributable to the shareholders at the group level, 73% growth to cross 4 billion. Actually, the enhanced profit after tax, the profit attributable to shareholder, is mainly the improved performance in the NDB group's capital market cluster. All of them have turned around, and that is also a good story where with the capital markets improving, all the subsidiaries have performed very well, especially the stockbroking arm, the wealth management arm. Both these have contributed quite well to the growth in overall profit attributable to the shareholders. Moving on to the balance sheet, despite all these economic challenges and all, we have grown the balance sheet by 6%. These are comparative numbers from December 2020 to June 2021. So 664 billion total asset base rupees. Investments almost the same at 158 billion. However, the gross loans, we had 43 billion growth for the first 6 months, which is about 10% growth in the loan book. And total deposits, we had 5% growth in the total deposits. Still, the deposit to loan to deposit ratio is around 94%. And the borrowings and the total equity. There's, of course, the equity, there's an improvement from 45 billion to 58, thanks to the rights issue, where we managed to raise 9.5 billion new funds through the rights issue. So the balance sheet growth is quite stable. Loan book also growth is very stable. It's coming from all 4 main business units: the retail banking, the SME side, corporate and project finance. I think the contribution from this first 6 months, corporate and retail are higher compared to, I would say, SME, because SME also we took a bit of a slow approach given the credit concerns in this sector, but that was covered very well by the corporate and the retail side. Total deposit growth, we exceeded 500 billion mark during this year. And as I mentioned earlier, exceptional growth in CASA base. Now we have 136 billion in CASA, which is 26%. And as I mentioned, year-to-date growth of 50% of the deposits have come from CASA. It's coming from all segments, especially on the granular CASA retail side. Even corporate and also NEOS app has also helped to have some good CASA base. So that's quite a good improvement in terms of the balance sheet. Moving on to the capital and liquidity position. Again, with the capital raising activities completed in the first half, common equity has improved to 10.43% from 9.1%. And the group level equity, total equity has improved to 10.83% when the minimum ratio is 6.5. Tier 1 capital ratio again 10.43, minimum of 8% required as per the regulator. And the total capital ratio has now improved to 14.73. We are maintaining quite a good liquid asset ratio. As you can see, 204%, I think quite liquid, even the liquid coverage ratio and all. So all those regulatory minimums have been maintained. Capital also has contributed to have a much stronger balance sheet compared to what it was in December last year. And these are the investor ratios. Despite all this, unfortunately, the share price, of course, after the rights issue, which was raised at 75 rupees a share price went up to about 82, 83 range. But with the current situation, it has come down to around 78, 79 range. But earnings per share has improved from 23 rupees to 28.9 rupees. And ROE, as I mentioned, 13.81, one of the highest ROE for the banks, and then ROA 1.68. Book value per share from 192 rupees as of December, it has come down to 161, mainly because of the increase in the share capital or number of shares issued through the rights issue. However, price earning times, again, that's the same reason for 2.78. Price to book value slightly improved to 0.5. However, this is actually that's reflecting the current low liquidity in the market and the market sentiment. However, the upside gains, upside potential for the NDB shares are much higher. Let me now share some insight on the strategic focus areas that we have been covering. As I mentioned, I think we have been we introduced our 5-year strategy, V25 or Voyage 2025 till 2025, to double our asset base and also triple our bottom line. And there are several strategic pillars that we focus. One key one is the digital, continue to invest on the digital platforms. So as a result, the NDB NEOS app is making very good progress. Quite a substantial new customer base that have joined us every month. Quite a significant NDB NEOS customers are getting added to that platform. We moved on to the QR-based payment system. We also introduced a CRIB scorecard and also the CRIB report downloading ability through the NEOS app. We are the first and only bank to do that so far, and first bank to commence the development of VKYC, video KYC, using AI technology where you match your face recognition technology, so that without a customer coming in, I mean, this is one of the key element which central bank allowed banks to onboard customers through VKYC process only in November last year. The regulations were relaxed. So with that, I think we are the first to move into that space. There are several other banks also coming in, but not probably the way that we are doing. So most likely we should be able to launch it within the next couple of months. With that, customer without onboarding or coming to a branch, you can open the account, and that will assist onboarding of several new customers, and that would also reduce the cost of opening new accounts, and that would actually revolutionize the way that we bank and moving more towards more digital services. And that would be quite a big change in the whole banking landscape. Also, we launched the Jayagamu Sri Lanka product again to support the entrepreneurs, the exporters, the need of the hour for the country, and that is progressing quite well. We have launched several platforms for them to showcase their products for the overseas market and also local market using the digital technology available. And that actually helping in a situation like this, in lockdown situation, then the COVID continuous. The avoidance of interactions are very well managed through such platforms. You basically order by looking at the product. So that has worked well. And also for the SME clients that we have offered the moratorium and all the concessions. Whilst growing our profitability, we also ensured that our CSR side is covered well. So we continued with the NDB care program, ensuring the staff safety, also our customers' interactions, and also the environment. So we have been contributing quite well to ensure wherever possible with our ability to go and support the community through various charitable activities. Staff members provided with various measures to protect from COVID, I mean, transport services that we have provided, all the healthcare services that we provide to ensure that their safety, all that. And then on the environment side, we have been contributing. So all that are covered through NDB Care. We have shared some good videos also done recently to share how we are contributing to that. The other key element is the Vanita Bimana, which is banking on women, empowering women in Sri Lanka. So we sponsored it last year. Despite the COVID situation, we managed to conclude that with a grand finale in March this year on the International Women's Day of 8th of March. And this week we actually signed up and we launched the second stage of Vanita Bimana. Again, empowering. Last time, all 9 provinces were covered, and we had 6,000 applicants, the women entrepreneurs taking part in that. Some of our staff also took part as judges, volunteered, and it was a roaring success. And with that knowledge, we are launching the second one, which we have already signed up, and the press conference was held again with the added feature of recognizing professional women in the corporate world also in 10 different categories, how they have contributed. This is all part of our support to ensure that women participation in our economy is much higher. right now only 35% women contribution to the economy, though they have population wise 52%. If you look at the undergraduates coming out from the university, 60% of the graduates are women. However, their contribution to the economy is lower. So that is part of NDB's responsibility. We thought that we should take this message across. So that is why we launched the Vanita Abhimani product. So these are some of the other key areas that we are supporting the economy, supporting the country. Going forward, the way forward, a little bit of Voyage 25 strategy that we launched in November last year. It's a midterm strategy guiding the NDB entire group towards the banking group of choice. So this is where NDB Bank has a unique advantage of having several group subsidiaries where we can get the best group synergy. So NDB Investment Banking, NDB Wealth Management, NDB Stockbroking, NDB Zephyr Funding, and also our subsidiary in Bangladesh in the investment banking side. How we can work together to ensure a holistic solution to our clients so that we can make the NDB banking group as the banking group of choice. So with that, the Voyage 2025 was launched, and key elements are, as I mentioned, one is the digital drive, providing customer solutions through more process efficiencies, all that through the digital platform, the cost efficiencies that we spoke of through the technology, and also a commitment to COVID-19 support scheme, and then through the transaction banking, more strategic focus on fee-based income, because we know that going forward the interest rates would be lower, so that to improve on that, the fee-based income through the transactional banking activities that we have spoken of, then more activities on the supplier financing, dealer financing, so that we provide a holistic solution. And that's where even the group companies are playing together with us when it comes to a investment banking deal, how the bank and the investment banking side can work together on those, working with the project finance team, all that, so that get the best out from the group synergies. And the last but not least, the banking on women platform that we have launched. And there again, NDB is in a better stance to launch this because we are the only EDGE certified entity in the country. EDGE stands for Economic Dividend for Gender Equality. So we have quite a good opportunities given for female staff as well to grow up in their ladder. And so as a result, naturally, NDB, our support to empowering women is one key area that we are working on. So all that basically covered in our V25 strategy. And I'm quite pleased to see the first 6 months of that V25 5-year strategy has reaped quite a good rich dividends, as you can see from the financial that was released. So that basically covers the prepared presentation that we are going to share with you. Now we are open for the question and answers. So along with my team, we are happy to take whatever the questions that you may have. So please share your questions on the Windows platform, and we will be able to share our answers to that. Thank you. So Edri, if you can brief, okay, how to pose questions. I mean, we just got one, I think. Okay. So there's one question on what is the outlook for interest rates and rupee depreciation for the next 12 months? Interesting question. So may I ask Niran to take it up, please? Niran is our Vice President Treasury.
Yes, it's a very, very difficult question to answer. But having said that, I think we have seen a little bit of a change in the interest rate scenario through the treasury bill rates and the treasury bond rates going up. But what we feel is that the policy rates may not be changed over the rest of the year and probably for the next quarter 2022 also, considering the economic growth factors right now. So I doubt that the policy rates may change much, but the treasury bill and treasury bond market rates might pick up a little bit, maybe 0.25% or maximum in the range of about 0.5%. That is our reading, mainly because of the short supply. And on the exchange rate side, yes, currently there's quite a lot of pressure has been built up, mainly because of the ballooning trade deficit. Now, generally, the country, we run a trade deficit, but it's generally supported through inward remittances and also the inflows from the tourism sector. Here we have seen both sides being slowed down, and obviously the tourism sector is not bringing in anything. And at the same time, export conversions also have come down. So what has happened is like there is a general perception that the exchange rate should move up. So because of that, but at the same time, the government and the central bank is quite confident that they will bring in about $2.5 to $3 billion during the next 3 months. So having consideration on that, we feel that if they use these dollars not only to reimpose their reserves, but also to use that dollars to some extent to cover the shortfall in the current FX market. So that might help to regain or at least to maintain the exchange rate at the current level. If that does not happen, of course, there's a huge chance that the exchange rate can move up. Even now, there is almost like a two-tier market in the range of 200 to 203 rupees, and also at a higher level in another market. I hope I answered the question, but I can't give the correct or rightful answer. But these are some of the possibilities. If, of course, some dollars are used to, as I said, to cover up some kind of a shortage in the market, then we should be able to stabilize the market at the current level. Thank you.
Thank you, Niran. There's another question on what percentage of loan book is currently under moratorium. Do you expect this number to increase further given the current COVID-19 outbreak? And yeah, I think I mentioned that answer. The total exposure under moratorium is about 17% of the loan book at the moment. This came down actually in the early by March. Actually, it came down to about 15%. But year end also that was somewhere around 17. But with the COVID situation continuing and central bank extending the time for application of moratorium, some customers have again applied for that. So that's why by end of this month, end of July, the total exposure under moratorium is around 17%. I think we should be able to manage it for the current COVID situation is still continuing. But it looks like there seems to be no lockdowns. As far as there are no lockdowns, there'll be business volumes, at least some continuation of business activities will continue. So based on that, our expectation is that the current exposure under moratorium would remain around 17%. On the other side, of course, the portfolio is also growing. So I think we should be able to manage within that 17-18% kind of a range, the exposure under moratorium. There's one question: what is the outlook for provision costs for the rest of 2021? Again, I would say that first half you would have seen we made total impairments of about 4 billion, and it's unlikely that the second half impairment would be much, higher as 4 billion. We are trying to manage it. It's all based on how the COVID situation is coming out. However, we are quite keen to ensure that we will manage it down than the first half. So it's all based on the developments that are taking place in the economy. But the signs of recovery we had seen, actually, the moment the economy was opened up, we had seen good signs of recovery. So I'm sure with the COVID situation taken control of in a few weeks' time, hopefully, I think the bouncing back situation is much high. So we should be able to manage our impairment costs down compared to the first half impairment costs. There's one question on what segments will NDB focus on in terms of loan growth and projected growth for second half. I would say that the growth has come from, as I mentioned, all sectors, but more importantly from corporate banking and also the retail banking side, because of the credit concerns on the SME sector, we didn't push much on that. I think we, instead of that, SME sector worked hard on managing the exposure, providing moratoriums, restructuring the exposure, supporting these clients rather than growing this portfolio aggressively like we did in the past. But that shortfall actually was helped very well by the increased activities in the corporate banking side, project finance side, and also the retail side. So all other three sectors contributed. So we would expect even the second half also the projected growth to be similar to first half. First half we had about 10%, but all in all, for the whole year, I would say about 17-18% growth in advances. That is what we are looking at. But it's all depend on how the COVID situation continues. But as of now we have already 1 month gone in the second half. So based on that, we may end up with about 17-18% overall asset growth, overall lending book growth. There's one question on the NPLs in the SME sector looking like, and how do you expect it to change? Overall, SME side, the NPL level is relatively higher than the other bank, other asset book. However, we see signs of improvement. Indika, our VP SMEs on this call, probably Indika can shed some light on how the things are improving on the SME side.
Yeah, actually, we have given, as CEO mentioned, more focus on the recovery and supporting the SMEs, because SME sector we see there's a issue in the cash flows, some of the businesses. So at the regional level as well as at the center, our more focus is basically support them, look at their cash flows, and offer a suitable restructure where they can come out of the present temporary issues they face. Because we were with SMEs over the last 4 decades, we know we came across these type of situations. This is a cycle, but same time we see they coming out of these issues. So it is important as a bank us to support them. So which we are doing, and we are seeing the signs. But of course, the issue is once they come out of the second wave, they has to face the third wave and again the fourth wave on the way. So, but I think we are closely following up, closely be with our customers and supporting them, and we see they are very resilient, because we saw after second wave. We started 2 months, they again came back to normal and started repaying. That shows how resilient these SMEs and the customer base. So we are closely working with them, and we see positive results once things get sorted.
Thank you, Indika. I think next question I would ask Vinoj to take this. It's about 1.25 billion growth in the loan book for the quarter. From which sectors these loans coming from? And the other second half of that question is there's a decent growth coming from trade finance side. Can you explain where this exactly coming from? So Vinoj is heading our corporate banking. So Vinoj, over to you.
I think the growth mainly came from the construction sector. There's another question, follow-up question by another investor. Probably I'll answer both together. There was decent growth which started happening on the construction sector in the last quarter of 2020 and continued. The momentum continued even at a higher pace in the first half of 2021. So the loan growth mainly came from our trading book, the construction book, and also from the export side. Yes, there has been a more than a decent growth in our import trade transactions, mainly because of our transactional banking setup, which CEO also explained during the presentation. I think this particular unit was set up mainly to focus and harness our trade potential that NDB had. I think that has seen a lot of traction during the first half of 2021. I think we expect that momentum to continue in the throughout this year as well.
Thanks, Vinod. Niranda has one further question. I don't know whether you want to take it. Did you see the interbank market for dollars easing after 300 million that came in after ISP repayment?
Yes, it's actually from the funding side. We felt that the market eased a little bit. That's why we saw the forward market discounts and all that moving down, moving back to the zero levels once again. That is from the funding side because the dollars were received by these respective banks. But but I don't think that it had any impact, much of an impact to the foreign exchange market. The foreign exchange market depends mainly from the exporter conversions and also depends on the importer demand. So where the dollars need to be converted into rupees for us to sell these dollars into the importers. So for that, there was not much of an impact. But from the funding side of it, the banks definitely benefited because their borrowings could have been repaid, and also for any loan assets and all that, they could have used those dollars. Yeah.
Thanks. There's one on Ramli. Thank you for the presentation. NDB has had solid growth in the last 2 quarters, whereas some of the other banks have had very muted growth. How has NDB achieved this, and what is the impact to yield? And the second half of that question is, are you seeing much demand from construction sector? So probably I'll take that. Yes, as I mentioned, the good sound platforms that we have laid has helped us to grow despite some of the other banks. We are not seeing that much of growth because I think we saw this coming, we planned this, we strategized things. So that the key element was ensuring staff safety, so that when you provide that, staff are also quite keen to go out and get the business. So I think, and those things, when you sort that out, I'm sure the staff contribution is also coming, and that's, I think, one key reason why we managed to grow despite the challenges. So that growth came from retail banking, where we have a strong sales team as well, and also the corporate banking. Again, we have one of the best corporate banking portfolio. It's a matter of how you get them to utilize the lines, and with that we saw growth coming from that side as well, and also the trade side. So that would continue. And to answer the second half, are you seeing much demand from the construction sector? Yes, we do see some demand, especially with the government's focus on some of the infrastructure projects which are still continuing, the road development, some of the other, especially after release of constructor payments that got stuck for many months in the past. We see progress on that side as well, despite the COVID situation. There's one question on what's our expectation for growth in profit after tax for the full year. Surendra, you would like to share your thoughts on that?
Yeah. Given that we have made 3.9 billion for the first half, we expect around, we won't expect the same levels, but we will expect a reasonable growth in the second half. However, given the pandemic situation and the impact on impairment, resultant impact on impairment may have an impact. So we expect to maintain the last year profits or above. So approximately maybe in the range of 8 to 10% growth over last year is what we expect.
Yeah, thanks. There's one other question about there's 1.3 billion write-offs for the quarter, which is much higher than any of the quarters write-off. What type of loans are these and in which sectors? So probably I'll take that. These are actually write-offs related to where the exposure was almost fully impaired, fully provided. So and these are some old large corporate related exposures, some export companies who got stuck in their export proceeds and all that they didn't receive for many months. So that's why we took a stance to, since exposure was fully provided, to write off, but for the recovery process is continuing, though we have written off under the memorandum accounts, we keep it and then follow up on the recovery. So these are some old accounts, old few large exposures that we thought that prudently better to clear the book rather than keeping it in the book. And how much of the deposit book has been repriced? I think Niran, will you take that? Repricing of the deposit book so far, first half?
Yes, you. Yeah, I think looking at it, I think almost the entire book, I would say around 90% of the book has already got repriced. So that's why we saw the restoration of the interest expenses on that, then the rates coming down on our cost of funds. It's only the very long-term liabilities, few deposits which are remaining currently. So we feel that major part of the book is being already repriced now to the lower rates.
Iran, you can take the other two questions as well, both on SCR
Yes.
accounts and the exporters.
Yeah, actually, from the central bank's point of view and from our side, there are no restrictions as such. Only thing is that we have seen there are certain delays for a few days and all that in certain when you prioritize your payments and all that. But otherwise, there are no restrictions as such imposed by the central bank or from the bank on the CR payments.
And also on the ISP, there are a couple of questions on the ISP holding. Please comment on
Yes.
banks, ISP holding, intentions of
Banks.
this portfolio going forward. So I think there were two questions on the ISP, so better talk about it.
Yeah, ISBs and SLDVs, yes, we do hold a decent amount because mainly that is anyway the banks hold these for our liquid asset ratio purposes in the foreign currency book, and also number two is also for our liquidity coverage ratio purposes. So it's that's the only way from the dollar book that you maintain your these two regulated ratios. So that also, and also by way of income by way of interest income, also to the bank maintains both these two portfolios, SLDBs and the international sovereign bonds for the time being at NDB.
And also our portfolio is quite long term. I think the assets that we are having are maturing in 2023 and above.
Yeah.
So
the
that's
SLDB portfolio is very much is in the is maturing in the range of 2022 to 2023. But the ISBs, which are at fairly decent yields, we have a longer duration there.
All right. Thank you for the PowerPoint. Is inorganic growth still pursued under your Voyage 2025? I think Voyage 2025 is purely on the organic growth strategies. But I think we are also looking at inorganic approaches, expansion overseas as well as the local expansion and some inorganic opportunities as well. It's too early to comment, but certainly though Voyage 2025 is a purely organic growth strategy, we do explore inorganic options for the bank. There's a question, Niran, on net open position. I think what I can say is it's very much under control. Yes, the banks, all the banks have basically are compelled to use the NOP position to manage the current forex liquidity situation. But in our case, I think our dollar inflows are also relatively higher compared to some of the other banks. So as a result, we have managed much within the NOP limit that is allocated to us with some pressure, but however, we continue to manage the NOP position. Vinod, there's a question to you on the construction
Yes,
side.
Yeah, this is on the mainly on the large constructions. I think we have top construction companies in our portfolio, and they do undertake large infrastructure projects. So this mainly the growth we have seen is coming only from these large mega infrastructure projects, and we have been supporting them throughout, and we have seen that growth coming in the first half, and we have seen quite a number of requests coming in the second half as well. So we will continue to explore those opportunities, Ramali.
Okay. In the absence of questions, I would ask Sanjay, our Senior Vice President, Retail and Branch Network, to share what's coming on in terms of family banking and some of the new things that we are launching. And thereafter, I will ask COO, Deepal and Damita to share a bit on digital banking side. And also how internally we have improved our efficiencies just for the benefit of the investors who are in this call. So first, Sanjay, can you share some of your thoughts?
Yes, CEO. I think for the benefit of the listeners, you would have noticed that we have advertised family banking around the beginning of the year. The concept is actually we are very strong in terms of the high net worth clientele, the individuals, and we thought we should look at the family banking concept to enhance their banking, not only to the individuals but to their entire family. So what we are giving them is the opportunity for the entire family to start banking with us, and together for them to grow into the higher segments and get the benefits of the higher segments that are being given. So that is the main idea, and this is part of our Voyage 25 strategy. And there are more to come, and we are looking at launching the another top tier segment, which will forthcome maybe within the next 2 weeks. So that's the plan in the retail side.
Thank you, Sanjay. Deepal, will you kindly speak about the process improvement, the workflows, and the success of the cost income ratio side, the improvement there, Deepal and Damita on the digital banking?
Yes, so I mean, I could say the main thing for the cost income ratio, what we concentrated was the automation side. Like, I mean, there are so many other methods as well, like, re-engineering, Lean Six Sigma, stuff like that. We use those, but I could say the main focus ours was, say, automation, because we thought, I mean, it's faster and, I mean, give us the results basically in a much shorter time frame as well. So in line with that, actually for the last 2 years, I could say we have automated 42 systems internally and externally, which are customer facing as well as for internal use. So even though these are internal use, ultimately it will end up by giving the benefit to the customer, the convenience as well. So as he also mentioned that by the automation of this, we have been able to sort of eliminate the requirement of having physical staff about 250 to 300. And what we did was, I mean, basically we reallocated them to do much more enriching work to the customer, like customer relationship management, customer handling, and things like that. So we are going to do it more and more. I mean, we are going to automate as much as possible. I mean, when you look at banking side, it is actually possible to automate everything handled by people in the bank. So basically, we are going to continue in this journey to automate everything what we can, and we will reallocate our staff, our colleagues to work with the customers more interaction with the customers, more helping customers, identifying customer requirements and giving them what exactly they want. So things like that, while people are focusing on automation, will take over the posting work, control work, and things like that. So that's the way we are proceeding, and we have made a considerable progress in that line that is clearly reflected in our cost to income ratio as well.
Thank you, Deepal. Damita, you want to talk about NEOS and the digital other things that are coming up so that.
Yeah, sure, CEO. I think CEO has covered most of it, but if I'm to talk about NEOS, our thought process is basically, if you really closely monitor us, we have been I think we as an NDB, we have been in this game of innovation for last couple of years, mainly looking at the customer experience side, looking at the customer pain points and then coming up with the right solutions. NDB NEOS Pay is the only banking app with the wallet and banking mobile app. And then, as CEO said, we have now gone into a different level with the crib integration. We are building a kind of an ecosystem, and near future we are planning to integrate even the share trading facility, because one of the main pain points of today's customer facing is that they have to use different apps for different purposes. So already we have integrated with our wealth and the NDB capital, where they can have entire portfolio. But now we are planning to take it to the next level, even to provide the share trading facility. There are another few key innovations in the pipeline, which I don't want to mention, but I think probably within next 2 months, those will be also out, because those are again market first areas. Just want to highlight, we have today in DB, about 80% of the transactions are happening in digital platform. So I think that is one of the key achievements as far as we are concerned. And also, if you look at, though we can see a lot of banks and other financial institutions, they are boasting on the number of downloads. But when it comes to digital, I think what is most important factor is the how many active customers who are using. So when it comes to NEOS, based on our UI, based on the experience and the user interfaces that we have created, I'm happy to mention that 80% of our transaction base is very active on the app. So that is a summary, but I'm happy to take any other questions with regard to this. Thank you. CEO, I think you're on mute, CEO.
Thank you. Sorry, thank you for, I mean, the absence of any further questions. I would propose that we conclude this webinar. So I would like to thank all the participants, the investors, the analysts who took part and also raised questions. So this will ensure that we have similar webinars to keep this interaction going with the investor community and share openly about what our plans are and also the underlying reason for the results. So thank you again for the participation, and thank you for my leadership team as well for participating and those who organized this webinar as well. Thank you so much. Thank you.